Well. Welcome to Crypto Fire Outpost, Episode 2, Compound Interest. So I was having a discussion with my son, and I was trying to figure out where I should start on the path of educating him on how to build wealth and how to invest. And the first thing to get him excited and to have him fully understand was compound interest. And I went to, you can Google this and just look up compound interest calculator. And the very first link should take you to investor.gov. I'm going to share this on the screen here. And this investor.gov, you put in on this form, you can put in an initial investment. So let's say I filled this out. Let's just say you put in $10,000 right now, today, and you don't contribute at all for the rest of, let's say, the next 40 years, which I have here. So length time in years is 40 years. You don't add a single cent more beyond that. And the estimated interest rate, let's just say it's like 10%. And that's your typical S&P 500, right? So if we calculate this into the compound frequency, you can compound it more. But let's just say, the worst case scenario would be annually, right? If you compound it daily, the more granular you calculate, compound it, of course, it'll be more. But let's say you compound it annually. So hitting this calculation, in 40 years, you end up with almost $500,000, right? And I wanted to show okay, so what were to happen if, let's say 40 years is a long time, right? So yeah, let's say 20 years, I'm retiring 20 years. Now, if the estimated interest rate was 40%, and before let's just say it was 40, just to demonstrate it, calculated, just wanted to show this difference. In half the time, if you could get 40% back, in 20 years, you would have, instead of half the time, you would have $8.3 million, right? So it's just to show that if you can actually get a CAGR, CAGR is compound annual growth rate. So the higher the CAGR really affects the time. So then the next question comes into, well, what can return that 40% per year? I mean, come on, there's no such thing, right? No, I truly believe there is, and there's that once in a lifetime opportunity right now, which is Bitcoin, right? So if you search up the Bitcoin CAGR, and you can kind of see here, Google it, but essentially you can look at in 1 year is 120, but on average, I'd say for the past 10 years, I mean, you have 84, 76, maybe 121 and 8 averages out to 60. So I'm just picking 40% on average, right? And not to say they'll stay like that in the future, it could, but it may achieve this in the past 10 years. I mean, it's probably higher than 40%. But it just shows that whatever the percentage is, if the higher it is, some years it might be better, it might be 60, some years it might be only 8, some years it's 121, whatever the case may be, having a higher CAGR is what you need to do if you want to reduce the length of time in years, right? And that significantly impacts you. And this is only putting in 10,000 right now, right? So, I mean, if you have a child or a kid in middle school, for example, or just born, and you just put that away and just put this in Bitcoin, man, in 20 years, you might have enough money for the entire family to retire. I mean, right, based upon this thing. And you can play with this yourself. So this is a lot of fun, right? And you can just make the length of time. You can put it in 40, just so you can see what it's like out. And I know this is pretty ridiculous right now. This is $7 billion in 40 years. And I know it seems like too crazy, right? But you can see here, year 20, what we had before, the 8.3 million, that's where we're at. But this is the power of compounding, right? But compounding for 40 years at 40% is pretty crazy. And if you were able to achieve that, putting in only $10,000 after 40 years would net you $7 billion, not million, billion dollars, right? So it's just to demonstrate the power of compounding. So realistically, if you were to play with this, let's say you put in 10,000 now, and if you were to contribute, and going back to length of years, let's go back to 20. We're going back to the Bitcoin example, estimated rate of 40. I'm just playing around here. I'm going to say, what if we ended up with 8.3, but let's say after 10,000, we just contribute $100 extra. Let's calculate that. So instead of your 8.3 ending in 20 years, you end up with 10.8. So just by adding $100 a month every month moving forward, which I think is doable, right? You end up with 10.8. So if you can do more, it'll be pretty more amazing, right? So if you're able to do, let's say 300, might be a stretch, but let's just say you're able to do that every month, right? So you'd end up after 20 years with 15, almost $16 million. But after look like after 10 years, you can see compared to the S&P 500 example, you would already reach, instead of waiting 40 years in the S&P 500, you're already at year 10 and you've already exceeded $500,000. You've already blown that in just 10 years, right? So, and this could be better, it could be better than 40%. So first I wanted to understand like compounding is very, very important. That's the point, right? So play with the numbers and just see that if you're able to save, put your money away and contribute, if you can do that too, that's great. But it's, you hear these phrases all the time. It's like, it's not timing the market, it's time in the market, right? I hear this being thrown around all the time for people like wanting to day trade and thinking they make a quick buck and stuff. Yeah, day trading is that's a whole nother area. I think that that's probably another episode. I mean, it can be done, but primarily to keep things simple for most people, I'm a fan of just kind of something where it's easy investing, like set it and forget it, right? Talk about that in another episode. But in this one, it's just really focused on just playing around with this calculator, understanding compounding, and envisioning like, hey, do something now when they're a kid. Put something away now, and then if you can contribute to it, that's great too. And you can see the different time frames and get to that point of seeing where you can achieve something. And of course, if you can put this in a Roth account, that's even better, right? Everybody, even your kid can put it in a Roth account. Of course, there's some rules around that. They have to be working for some companies, so you got to create like an LLC and get them as an employee. But then once they're able to do that, they can contribute like 6,000 to it, right? So once you have 6,000 into it, so even looking at 20 years of just say Bitcoin, just seeing where it could end up. I mean, just putting in Roth right now, by the time, I don't know if they were just born or not born, let's say they're like 10 years old or something. So in 20 years, by the time they're 30, they may have over $5 million already. Just from that one thing and you never adding another monthly contribution again. Right? That's crazy, right? In my head, it's like that's too good to be true. But that's all because of this CAGR, because it's 40%. But what other asset that you can reliably, because I grew up and I firmly believe in this, that if there's no risk and reward go hand in hand, right? So if you have no risk, there's no reward. But I think Bitcoin is a little misunderstood because people see the volatility as risk. And I disagree with that. I think Bitcoin there is some risk in some ways to it, but it's a very calculated and it's very low risk. And so it's a very unique type of asset. So it almost breaks that rule. That's why it's like a once in a lifetime. It's a very strange, it's a very strange asset to that respect, right? We will go definitely into it more, and that's the purpose of this channel, is to explain why I feel that way and fully explain out why Bitcoin is low risk actually. But people are just afraid of the high volatility. But hey, that in a sense is that risk. You're risking high volatility. I think it's probably the best way of seeing it, is that you have high risk of volatility, but that's why you're able to get these high CAGR returns year after year on average, right? So yeah. So yeah, have fun. I think start with your kids and just show them the power of this and see what makes you excited. I mean, I would keep this at 40, but if you change this even higher, it goes even more crazy, right? I mean, what's funny too is like if you look at here, 1 year Bitcoin return 121. I mean, sorry, right here, CAGR 121. Coming back to this, it won't even let you do that on the calculator. If I try to do 121, calculate, yeah, see one error, estimated interest rate. It must be below 100%. It's just unheard of. It's just like no one in the traditional finance market, it doesn't even bother to calculate it because it doesn't even think it exists. But in the crypto world, it can, right? It can. But let's just keep it to even the current lowest value over the past 10 years. On average, I would say 40 is probably good, but just for fun on this channel too. We saw it at 40, right? So let's go ahead and calculate that. That was 5 million in 20 years. Let's just say if it was 60, just for kicks. We went to 60. So we have 72 million in 20 years, right? And you can see how the compounding, it's just like it's like nothing. Even year 10, it's just a little bit more, 600,000 versus 500,000, right? But then this is where it's like these just like last years, it's crazy after year 10. it skyrockets, right? Year 10, it goes from 659,000 to 1 mil to 2.7 mil to 4.3 mil, like every year after that. So again, it's the time in the market, letting it compound. And I'd explain this to my kid. So compounding is not necessarily, to me, the way I explain it to him is that you look at an asset, how it performs for the year. And so let's say it goes up 10%. You have 100,000 and it goes up 10%. So now you have 110,000, right? So the time resets. So then you look at the next year. If you were to take that 10,000 out and you now left with 100,000 and it grows again at the rate of 10% a year, you have the same thing. At the end of the year, you end up with 110,000. And if you keep doing that, you always have 100,000 there, but you get to take out 10,000 each time. But what happened if you don't take it out every year? So you have 100,000, and at the end of the year, you end up with 110,000. Now the next year, you make 10%, but you're making 10% now off of 110,000. So what do you end up with, right? You end up with 11,000 or whatever the math is, right? 11,000 profit. So now you have 110,000 plus 11,000. So that would be 121,000. And that's what's the next year if you left the money in there. You'd make 10% off 121,000. And so I was explaining that to my son. And so I think he quickly got that the idea of compound interest doesn't necessarily come from putting more money into the system, and it's not necessarily like a dividend or something that gets paid out and it keeps compounding. I think you might get confused that, oh, it has to have paid dividend or has to pay something out, right, to get it. No, it's just, to me, it's a time frame. You pick a year. Let's say we typically look at it at a yearly basis, and you end up with some growth in that year. Great. Stop the clock, reset it. If you leave the money there, then the next year it's going to compound and take whatever you earned the previous year, and now if you earn the same percentage or even more, it's going to count against a larger dollar amount. So it just keeps compounding. And that's what's happening in this chart here, where you leave the money. So, all righty. Well, thanks for stopping by. Until next time, be well.